Hello and welcome to your trader training. My name is Phil Newton and I am your trading coach. And on this training session we're going to look at the setup that we described for maximizing a debit spread for profitability. What we're going to do on this training session is we're going to make a few assumptions and we're going to assume that for the moment I'm bullish on the stock, meaning that I will benefit if the stock price moves higher, and that means that I'm going to focus my attention on the call side. Please just note that we would be doing the opposites if we were bearish and we were going to benefit if the stock price was to move lower. We'd be focusing our attention on the put side. So for the moment then, we're going to go to the call side. We're bullish, and the first place that we need to start is to set the trade up just like we were going to do with the profitability setup. I'm going to make a maximum width debit spread as if I'm doing it for probability. So I'm going to go to my one strike in the money, which is just where the cursor is. I'm going to right click, I'm going to buy, I'm going to vertical, and it pre-populates an order down at the bottom. Now what I want to do is just track my eyes down the probability being in the money column. So I've got my one strike in the money just here, and I'm looking for the nearest strike to one standard deviation, and I like to go just the other side. It's just a personal preference, but the nearest strike to 34% is that one there. So tracking my eyes to the center, I'm going to go as wide as 139. So what I need to do is just change the order ticket at the bottom and change that to 139. So 135 strike is the one that I'm buying, the one strike in the money, and the one that's as far away as I could sell is at 139. So this is a $4 wide spread. So let's just mark that down here. So this is $4 wide. So $4 wide. Now what I want to note, so how did I get that? I just looked at the difference between 135 and 139. That gave me $4 wide. I'm also looking at the price to see what it's being quoted at. So what I'm going to do to work out how much I can maximize for profits, I need to know what my risk is. So let's just assume that my personal risk is $250, or another way of saying that is $2.50 per share. So right now, if I was to do this $4 spread, it would cost me $1.75, and that means that my maximum profit is $4 minus $1.75, and that means that my maximum profit is $2.25. So that the risk and the reward. Now that means that I can do one lot. So if I've got a risk of 175 on this setup, and my personal risk is 250, I can trade with one of these, but I can't trade with two. So this means that this setup gives me one lot. So the next thing that I want to do now, so this is where the difference is. So that's my maximum width spread. It's as wide as I can make it while still keeping a nice balance of price and probability. But what we're saying is that I don't need to worry about probability. If I'm adamant that my direction is right and I think that the stock price will go up, what I can do is I can sacrifice some of the probability to try and maximize for profits. So the way that I'm going to do that is I'm going to move the side that I buy one strike closer, and I'll continue to do that and check the size of the spreads and compare them against each other. So I'm going to leave the short strike, the one that I'm selling, where it is, but I'm going to move the buy side closer to the sell side. So that's the primary difference between making an adjustment for profits versus probability. The probability spread, we move the sell side closer to the buy side, and when we're maximizing for profits, we're going to move the buy side closer to the sell side. So now what I'm going to do is I'm going to work out what a $3 spread looks like. moving the buy side from 135 to 136. That will make it now $3 wide. Risk is now 122. My maximum reward will obviously change, and all it is, it's $3 wide minus the price that I paid is going to give me my maximum profit. So $3 minus 122. And that's going to give me 178. Again, still using my maximum personal risk of $2.50. I'm now thinking to myself, well, how many of these $3 spreads? Again, remember, I can only do one of the four. How many of the $3 spreads can I do? So it's how many 122s go into 250? Well, I can do two of these, and that would give me a maximum. Let's just work it out again. So it's now 244 is my maximum risk, but again, that's with two lots. That means that my maximum rewards will also double. So what we can start to see here is we're massaging the spread. We're still keeping some reasonable expectation because we're inside of our standard deviation movements. But what we're trying to do is we're basically massaging the size of the spread to see, okay, well, with the risk that I have, the dollar amounts risk that I have, how many contracts can I do with the different size spreads? So then the next one that I want to evaluate is $2 wide. So I'm going to change the 136 to 137. It's now $2 wide. I'm being quoted at 0.76. So $2 minus 76 cents gives me 124 as my maximum reward per contract. And now what I do, just divide one into the other. So divide 76 into 250. So how many 76s go into $2.50? And that'll give me the number of contracts. So 2.5 divided by 0.76 is going to give me 3.2. We can't trade a fraction, so it's going to be 3 lots. 3 times the figures that we worked out. So 228 is going to be my cost, and you'll notice that I'm under budget. It needs to be under $2.50, and my reward is going to be 3 times 124, and that gives me 372. So now, again, hopefully you're starting to see, I'm just trying to figure out which of these contracts. For the moment, the $2 spread is looking like it's going to offer the most amount of profits, and it's actually going to be less risk. If you compare the $2 with the $3, I'm risking $2.44 for the $3, only $2.28 for the $2 spread, but the profit, the maximum rewards, is greater with the $2 spread. Now, it won't always be this way, because depending on how the size of the spread works and the number of contracts and how it's quoted and the price at that moment, it might not work out always the way that it works out. You would imagine that the $1 spread, that when we work it out, might give us the best bang for buck, the most amount of profits for what is effectively the same or less amount risk. But we need to work it out because we don't know for certain. Sometimes the $2 spread is going to be the best choice. We might not be able to get a best maximum risk to maximum rewards for the $1 spread. So we need to work it out. So $1 spread, let's look at it. So the 37 goes to 38. It's now a $1 spread, and I'm being quoted at 35 cents. So to get the profits, max profit, $1 minus 35 cents is going to be 65. Per contract, yes, we've got less risk, we've got less rewards, but again, we're trying to figure out what's my multiplier, because that's how this works with the maximizing for profit. It's this contract multiplier. So 250, how many 35s go into $2.50? And I've got 7.1 and change. Can't do fractions, so it's going to be 7 lots. And we only get that, again, 250 divided by 0.35 gives me 7. So now I can multiply it out. 7 times 35 and 7 times 65, or 0.35 and 0.65. And that gives me 245 for the cost. Again, we're under budget. That's how that works. So we've managed the risk, still in budget. How much profit could I make? It's now moved up to $4.55. as the maximum profits. So what we're starting to see here is it looks like the risk is all relatively similar. We're under budget. At $2.50 is what we were aiming to be under. But now I can compare them all next to each other. I can do one contract $4 wide. I can do 2 lots $3 wide, 3 lots at $2 wide, but 7 lots at $1 wide because of the way that it's currently priced. Again, I just want to restate, it won't always be this way. It's just the way it worked out on this occasion. So we still need to go through this process to work out what our maximum cost is and our maximum rewards. Now we can compare the profit and the cost. So for under budget, $2.45 per share per contract. So we're under budget, gives us a maximum profit potential of $4.55 per share. So that is by far the maximum amount of profits that I could aim for with a $1 spread. Again, and it assumes that we can multiply the number of lots. That's what we're aiming for. It's that contract multiplier that makes this work with the maximizing for profits. So all we're doing is we're incrementally making the spread smaller, but now instead of trying to keep this balance for probability, we're trying to balance for profits. And we're moving the side that we buy further out the money, closer to the side that we're selling, because we've already got that at the furthest away that we would sell, so we're not going to make it any wider, any further away. So we're just making that spread smaller, and as we're doing that, we're working out, okay, well, how much risk do I have? What's my maximum cost? And how does that compare if I can multiply it by the number of contracts to maximize for profits? So just going through this, we had 4 spreads that we can do, and it looks like the $1 spread gives me the budget requirement, if you like, of $2.50 per share, or $250 per contract. I can multiply that by 7 lots, and that gives me a maximum profit of $4.55 per share, or $455 per contract. And again, it's multiplied 7 times, so that gives me my risk that's in budget versus the profit maximizer. So we're sacrificing some of that probability that we worked out by staying inside the standard deviation. We're not completely throwing the baby out with the bathwater, because we've still got this realistic expectation that the stock price could do that, but we are at the extreme reaches of what might be considered a normal movement, because this $1 spread, it's right on the edge of that standard deviation move. It's got a little bit of way to travel before we start hitting pay dirt, but at the same time, if we're right, we'll get paid handsomely. And that's the trade-off.